Welcome back to the Undervalued Investor YouTube channel, where today we're taking a look at the broader indices going into the holiday seasons after the S&P 500 just about peaked its all-time high before pulling back in one of the greatest corrections since the October lows. Now, getting into it, we're also going to talk about where I think the best returns are going to be in 2024. And if that is a conversation you'd appreciate, as always, just hit that like button. But getting into it, let's take a look at the other indices. The NASDAQ is still trading down about 7% from its peak of 2022, actually lagging the S&P, which comes as a bit of a surprise because usually this is where we see the most outperformance because of the tech-heavy sector that sits in the NASDAQ. The Dow Jones actually outpacing all the indices, trading up 2.32 or 2.38% since its 2022 or coming to the 2022 peak. We also got the Russell 2000, where I'm very intrigued because this one is still down 18% and had the greatest rally from the October low, still up about 22%. And I really want to talk about the Russell because I think this is where we're going to see the highest rates of return, especially as we head into the interest rate cut cycle. You got to remember the recent rallies all came because of the Federal Reserve pausing interest rates. And because they paused rates, that means that companies that have heavy debts, especially companies that sit on the lower S&P 500, now have the potential to see their earnings, start to bottom up because they're not going to be getting extended debt payments. And then as we go into the interest rate cut cycle, those companies will start adding that revenue back to their bottom line. And that's why I'm suspecting that we're seeing the lower half of the S&P actually rally this month, and it's not actually the tech stocks that are taking the S&P up. That's likely why the NASDAQ has been underperforming over the last month, is because of this lower half of the S&P. We see it specifically with a lot of the banks, pretty much every sector outside of the major tech companies, right? You take a look at Wells Fargo here. The banks have just been going on a historic run here. Wells Fargo is up almost 30%. JP Morgan from the October low here is up 22%. Basically starting to push back toward their all-time highs. And this comes during a period where the S&P 500's price to earnings multiple sits at around 26, which historically is pretty high. But when we take a look at growth rates returning, so long as growth rates stay in the teens, especially for the big tech companies, it's no surprise that the multiples stay this high. But you got to remember, the lower half of the market isn't trading at such a high multiple. A lot of the dividend ETFs are trading for around multiples of 15. Similarly, with companies like SCHD that people love, this is an ETF focused on the Dow 100 dividend stocks. And this one, though, not peaking its all-time high. If you take into consideration the dividends since 2022, you're pretty much there. You're pretty much flat since that time period, especially if you've been buying up the dips. You've been doing exceptionally well. And this one's price to earnings multiple, which we can just take a look at, actually only trades within the PE range of around 15. But what's most intriguing to me is the small cap. I mean, you can take a look at quite a few different ETFs. There's the Avantis US Small Cap ETF that is actually going back to an all-time high, which is very fascinating to me. And then there's also a company called VBR, the Vanguard Small Cap Value ETF, that actually trades for a price to earnings multiple of only 11. I mean, I'm kind of mind-boggled that these small caps have had the slowest recovery in this market, considering they have the highest growth potential because of the market cap size. And they'll be the companies that are probably most affected by interest rates, because if they cut interest rates, the liquidity that comes into the smaller cap and venture capital markets gets much, much better. And again, continues to see pretty much better growth against the larger cap like companies. So I think we're going to see the best rate of return coming out of these kind of ETFs that still have lots of room to run. So something to just consider as you go into 2024 when you're allocating your money and where it might be best suited for return. But I'll pass that question off to you. I'd love to know what you think in that comment section below.